Alright, we're on part 3 now of the presentation, starting on slide 50 for chapter 10. And on slide 50, we're talking about off-balance sheet financing as a way that a company can either obtain financing or avoid reporting potentially negative financial information without necessarily having to show it as a liability. Contingencies are events with uncertain outcomes, and therefore the dollar impact may be difficult, if not impossible, to estimate. They may, however, create liabilities at some point, such as in the case of lawsuits against the company. Contingencies should therefore be disclosed in the notes to the financial statements, whether or not you have a good idea of how much potential liability there may eventually be. If a reasonable estimate can be made of the potential impact, that should be disclosed also. The leasing situation occurs when a lease that may have the characteristics of a capital lease, which kind of goes beyond the scope of this course, and therefore should be recorded as both an asset and a liability, is instead recorded as an operating expense to avoid the increase in liabilities. Based on Southwest Airlines' example on page 527, you can see what the impact is of including the amount of the capital lease on the debt to total assets ratio. And it's not a good result for Southwest, even though it's adding the same amount to both the assets and liability side. On slide 51, this vignette illustrates the importance of having some debt covenants in place to protect the lender from financial difficulties of the borrower that might otherwise go unnoticed. See page 564 for further discussion of that. Alright, on slide 52, we're moving into the subject of amortizing the bond discount. And in the simple or straight line method of bond discount or premium amortization, we simply divide the discount amount by the number of interest periods to be the amortization amount per period, much in the same way we compute depreciation expense for a plant asset. The amortized amount must be included as an expense of the period because of the matching principle. On slide 53, in this example that was shown on a previous slide, not only is the interest payable to date accrued for the year, but the discount on bonds payable account with the debit balance is credited for 1/5 of the discount amount, since they are 5-year bonds. That explains the $400 credit to discount on bonds payable. On slide 54, this chart shows the annual amortization of the bond discount over the 5-year life of the bonds payable. Note how the bond carrying value increases with each year as the discount is amortized, that is reduced by $400 per year. On slide 55, with amortizing bond premium, we have a similar situation, but the entries are mirror images of what we did with the discount situation. The amortized bond premium for the year is a debit to the premium on bonds payable account, since that normally has a credit balance. And note how interest expense is debited only for $9,600, although the payable amount is $10,000, and that is indeed the amount that will be paid. On slide 56, this chart shows the impact per year of the bond premium amortization. Note again that the bond carrying value is working its way back to the face value of $100,000, just as it did with the discount example, only this time in the opposite direction. Note also that the interest to be paid is still $10,000 per year, despite the interest expense being only $9,600 per year. This is because the remainder is the debit to the premium on bonds payable account, recognizing the amortization of the premium amount. And going to slide 57, you will not be tested on the effective interest method in this course, so there won't be any homework assigned on this method either. I will just briefly cover it because those of you who may go on in accounting will certainly be exposed to this again at some point. As shown on the slide, the amortization amount per year is the result of a formula that computes the bond interest expense and the bond interest paid for each period. And here they're showing again the example of a candlestick with the 100,000 5-year 10% bonds sold at a discount. And they're saying the effective interest rate is 10.53%, which is a separate calculation that, again, we won't get into here. But that means that percentage is going to be applied each year of the bond's life to compute the amortized amount. So the amortized amount each year will be different under the effective interest method, but the interest rate that's being used to compute it is the same each year. And that's why the general accepted accounting principles try to steer companies in the direction of using this method, especially if it makes a big difference with this versus the simple or the straight line method. And here's the journal entry is basically the same as under the straight line. It's just that the amount of the discount on bonds payable that's amortized is different. It's 319 as shown here for the year 1 versus the 400 under the simple or straight line method. And with a premium situation, and I'm on slide 61 now, notice how the effective interest rate is less than the contract rate. What that may be telling us is that the bond owner already paid some upfront interest by buying the bonds at a premium over their face value. Therefore, the amount he's getting per year, the effective rate, is really somewhat less than the contract rate overall. And the calculations are the same as we go to slide 62 as for the discount example, just in reverse regarding the change to the carrying value over the life of the bonds. We're still using the same effective interest rate percentage to compute the amortized amount each year. But it's computed on a different amount, obviously, as the carrying value changes over time. And again, here's the entry for amortizing the premium on bonds payable, in this case $330 for year 1 versus the $400 that it was in the straight line method. Alright, moving to slide 64 and long-term notes payable, which normally involve something like a mortgage. This is a typical example, like a mortgage on plant property such as a building. And in this case, the borrower makes installment payments over time that resemble what homeowners make on their mortgage loans. That is, each payment consists of both some interest and some principal payment, and these amounts change over time. On slide 65, notice how in this case the interest portion of the semi-annual payment takes up most of the payment, as it does in the early years of a home mortgage loan as well. Then as time goes on, the interest amount gradually decreases and the principal amount increases. On slide 66, the entries above are for the initial mortgage loan agreement proceeds, and then the first semi-annual payment on the loan, which comprises both interest and principal as indicated by the debits to interest expense and mortgage payable. So on this question of each payment on the mortgage note payable consists of, as we saw in the previous example, D is the correct answer because the interest is computed on the unpaid balance of the loan, and that is why it decreases over time, and each payment includes reduction of the principal as well. And now, good old IFRS. We'll just spend a couple of minutes and a couple of slides on this before we wrap up. It won't be covered in the homework or testing, so this is just informational. And the next couple of slides discuss the commonality of IFRS with GAAP in the area of liabilities. Very similar regarding the definition of liabilities and the classification of liabilities as current and non-current. And again, other similarities in terms of classifying current liabilities, reporting of liabilities, and preferred stock required to be redeemed at a specific point in time must be reported as a debt rather than being presented as either equity or in a mezzanine area between debt and equity. So a lot of agreement between the two thus far. Now here's a few differences. Uh, Under IFRS, companies sometimes will net current liabilities against current assets to show working capital. IFRS requires the use of effective interest method. GAAP allows the use of a straight line where the difference is not material with the effective interest rate. And IFRS splits the proceeds from convertible bond between an equity component and a debt component, unlike GAAP. So basically, that wraps up what we need to say about that and about this chapter. So that wraps up the presentation. And please use the discussion board for any questions, or email me if you feel you need to do that as well.